guys, this is Ted from Boom Traders, and today I'm going to present to you our short series video for this week, in which we will understand better what is a moving average, how to use it in technical analysis, and what to be aware of. You have probably heard us speak a lot about moving averages in our analysis and trade alerts. We have also received questions, what is an EMA or what is an SMA? So that is why I decided to create this video, and I hope it will be useful for you. This is our plan for today. First, we're going to discuss what is a moving average and why it is important for our analysis. Then we will see how to generate signals with a moving average, where to buy, where to sell, or just to hold. We will go over the different types of moving averages and the settings that we can customize. We'll discuss also some strategies and disadvantages. And of course, I will give you examples how to use them. But first and foremost, let's start with the old saying that the trend is your friend. We at Boom Traders, we're trend followers. What does it mean? It means that a security that goes up is more likely to keep going up. And having a clear view of the trend can help us decide where to buy, sell, or hold. So how do we identify trends? Well, this is where the moving averages come in. They're one of the simplest ways to identify a trend. But let's explain what exactly is a moving average. It is one of the oldest tools used by technicians and technical analysts. It tracks the price over a specified time period and smooths the fluctuations of the price. And it just allows us to focus on the trend. And as I told you before, we do not buy against the trend. We are trend followers, and moving averages allow us to identify the trend easily. Let's see how it looks on the chart. Okay, here is an example of a 50-day moving average. You can see that the general trend is really easy to identify. It goes up. You just follow the direction of the moving average. And also there are a lot of price fluctuations like here, here, here that are smoothed by the moving average. But at the end, how can you use this information to take advantage? As I just told you, a moving average helps us cut down the amount of noise on a price chart. We look at the direction of the moving average to get a basic idea of which way the price is moving. If it is angled up, the price is moving up, or at least it was recently moving up. I will explain this concept later. If it is angled down, then the price is moving down, and if the moving average is moving sideways, then the price is likely in a range. It also helps us to identify support and resistance levels, as well as trend breaks. A long-term moving average can trail behind the market and act like a support in a bull market. It can also be used as a trailing stop. I don't know if you're aware of the concept of trailing stops. If you're not, we can make a video about this concept as well. Then, with the help of the moving average, we can easily spot price extremes. Remember that prices tend to return to their average. This strategy is called mean reversion. It is also another concept that we can make a video about. And when the price goes back to the moving average, this is a good place to add a position. And finally, it is a great tool that can generate buy signals. Let's see how. First, if the price breaks above a moving average, then this could be considered as a buy signal. If the price breaks below a moving average, then this could be a sell signal. But one thing that you have to be aware of are whipsaws. When the stock crosses over a moving average, giving one signal, and then reverses quickly, giving the opposite signal, then this is a whipsaw. Short-term time frame usually shows more whipsaws, and that's why more investors prefer to use intermediate and long-term moving averages. We're going to explain later what are the different types of moving averages. And lastly, we can expect a bounce from a moving average when it acts as a support. Let's see an example of this. Okay, here it's again the same S&P 500 chart from last year. And you can see that this is definitely a bull market. We can see the direction of the trend really easily. And I have highlighted the spots where the price goes back to the moving average and where the moving average can be used as a support line. It can also be used as a trailing stop, as I told you. Okay. You probably heard us saying something like 50 daily moving average, 200 daily simple moving average in our analysis, and you are wondering what does this mean. I'm going to explain this to you now. Well, a moving average has a couple of characteristics: type, length, and a source. And I will explain you what all of these mean. A moving average by its nature is just one number that represents a net of certain past numbers. In these cases that I'm showing you here, it's 200, 50, and 10. For example, 50-day moving average is one number that represents all the prices for the past 50 days combined and then divided by 50. Then we have daily or hourly. This is just the time frame that we are using. And last, we see SMA, EMA, and so on. These are different types of moving averages. We'll discuss that soon. And as I told you, moving averages are a totally customizable indicator, which means that you can freely choose whatever time frame you want when calculating an average. The most used time periods are 20, 50, 100, and 200 days. The shorter the time span used to create the average, the more sensitive it will be to price changes. And the longer the time span, the less sensitive it will be to price changes. You may choose different time periods of varying lengths to calculate moving averages based on your trading objectives. You should know that shorter moving averages are typically used for short-term trading, while longer-term moving averages are more suited for long-term investors. There is no correct time frame to use when setting up your moving average. And in my opinion, the best way to figure out which one works best for you is to experiment with a number of different time periods until you find one that fits your strategy. Here is an example that I have prepared for you of two different moving averages visualized on the same chart. In this case, we have the 50 daily EMA and the 200 daily SMA. And after the last slide, you probably understand now what these labels mean and what the combination of letters and numbers means. But probably the first thing that you can spot on the previous slide is that we used two different moving averages for the first time during this lesson. And this is commonly used strategy by us, and you can see us use as many as 6 or 7 moving averages on the same chart. This gives us a couple of advantages. First, we can see if they are stacked positive or negative. If that is the case, it means that the trend is strong. Stacked positive means that shorter term moving averages are above longer term moving averages, and the opposite. If it's a downtrend, shorter term moving averages are below longer term moving averages. Then the next strategy that we can use with multiple moving averages is called crossover. Using a crossover of two moving averages can help us take advantage of the responsiveness of the short-term moving average while waiting for the long-term to react. This is a great strategy for trending security. However, you should remember that in sideways markets, there can still be a lot of whipsaw. In this case, it is better to look for other patterns. Let's go back to the chart. Again, same chart, S&P 500 futures from last year. And I have highlighted the place and the spot where the moving average crossover has happened, just here. And you can see that this crossover was followed by 18 months long bullish move. It was an amazing buy signal. So you should definitely pay attention to this type of signals. Of course, as every other tool in technical analysis, there are disadvantages of the simple moving average. The main one is that SMAs are slow to reflect price changes. There is a lag because they give equal weight to all periods. Of course, there is a way to avoid this, and it is to use another type of moving average, like weighted or exponential. These types of MAs consider recent data more important and give it more weight. Therefore, they react quickly to price changes. They're definitely better for shorter time frames. And you'll see us at Boom Traders that we use a lot of EMAs for 10 or 20 periods, even 50 in some cases. What exactly is an EMA or exponential moving average? The most important aspect of it is that it does not drop off the earliest data. All data is considered in the calculation. This is to avoid the drop-off effect where signals can be generated because of the values that are removed rather than the ones that are added at the end of the calculation. The exponential moving average doubles the weight of the current price and applies the remaining weight to the previous EMA value. Therefore, it can react much faster to turns in price than the simple moving average. Some things to note: moving averages don't predict future performance. You should be aware of this. They can only help you to confirm already established trends. And finally, to conclude, guys, even with these drawbacks, moving averages are a powerful tool in technical analysis that will help you to see trends and identify buy and sell signals. You can also use them as support and resistance levels, or as I told you, as trailing stops. And that was it from me today, guys. Thanks for watching, and if you like the content, make sure to subscribe to our channels in the description below. If you want us to make a video about a topic that you don't fully understand, please let us know in the comments, and we'll consider it. So see you next time. Thanks for watching. Bye bye.